All right.
Yep.
I'll give it a minute or two for folks to come in, and then I'll get started.
Brilliant. I'm going to put the spotlight on you, Sarah. How does that work?
Great. Wonderful. It is 4 a.m. where I am. So
Oh my God, I didn't even think.
hopefully
Yes, this is a very early start. Thank you so much.
oh, totally fine. I have relocated to the West Coast for the duration of September. So I signed up before I knew I was doing this, and then I was like, that's fine. I'll be on East Coast time. But
So did you wake up or you're not gone to bed yet?
I went to bed. I will go to bed again after this. So
Amazing. In just a quick shout out to all the interns. Please thank Sarah for this. It's 4 a.m.
totally fine. Totally fine. I've probably asked enough people to do that by my own volition. So, but if you hear me struggling to put words together, that is why. But hopefully that will not be the case for the most part.
Brilliant.
All right.
Just a
Why
very
not?
quick, bit of housekeeping for me. A couple of you have asked about mentors. We're going to be emailing everyone next week, getting you allocated to your mentors so we can begin that process. And also, if anyone's still struggling to get into Slack or Notion, just drop me an email, seb@futurevc.com. Great. This is our third masterclass of the week, fourth event of the week. So a really busy week for the interns. Sarah, over to you.
Wonderful. So before I go ahead and share my screen and get myself introduced, and most of my presentation will be about the fund that I work for and impact investing in general. But just as a brief introduction to myself, my name is Sarah Millar. I am typically based in New York City. I am currently based in Oakland, California. So it is 4 a.m. where I am, but I am also the lead for Future VC and Diversity VC in the US. And so this is a project or a team that I've been working on for a couple of years now. So more than happy to wake up as early as possible to provide whatever I can for Future VC. A little bit of my background before we get started. I have been working at a fund called CityLight Capital for the last 5 years. We are an early stage impact investing fund. I had gone back to business school about 7 years ago at this point, specifically to get into impact investing. And so I'll tell you a little bit about kind of my journey and how to think about different types of impact investing. But with that, let me share my screen and go right into it. All right. So I'm going to start with kind of a description of the fund that I currently work for to get a little bit narrower into exactly what I define as impact investing, and then I'll go a little bit bigger around what is the definition of impact investing, what does impact investing mean for different types of investors. So CityLight, where, as I said, I've been for the last 5 years, is an early stage fund. We invest in seed and Series A stage companies that have positive social and environmental impact, and the tagline that we use is solutions where more revenue equals better lives at scale every time. I don't think we have that trademarked yet, but definitely have been trying to. And the idea behind that, which I'll get into in a second, is we invest in companies where there is a direct tie between what the company produces or what their service is and the impact that they have, meaning there has to be an inextricable tie between how they make money and how they have impact. And I'll get into that in just a second. For my fund, the focus areas are both very defined as well as very broad. We say that we focus on 3 different sectors, broadly speaking. Those are education, safety and care, and the environment. I would think of those as anything that touches upskilling or reskilling of the population, whether that's at age 5 or age 55. Safety and care encompasses everything from first responders to mental health and behavioral health, We generally don't touch pharmaceuticals or medical devices because none of us are smart enough to know what's going to work there. And then environment is anything that touches climate change. But again, what we're looking for are companies that at the highest level are improving, and as it says at the bottom here, are impacting disproportionately diverse and disadvantaged populations. But the way that we talk about that from an impact perspective is increased affordability, accessibility, and improved outcomes. The affordability and accessibility can kind of be tracked across different sectors. You can always get a metric that says, here's the cost savings, or here's the diversity of the type of customer that you're serving. The improved outcomes is really dependent on what the company is trying to accomplish. And I'll get into a little bit of what that looks like a little bit later on. I'm going to go through this very quickly. We talk about our focus as being driven by our beliefs. And we primarily use this slide to talk to our investors around why is it that we do the type of investing that we do, and why is it that thesis and that viewpoint will not only be positively impactful, but will actually make us money in the long term. And our belief is that there are incredible entrepreneurs who are trying to solve these problems and are doing so in ways that probably would be overlooked by traditional capital, or that might even be overlooked by traditional venture capital. And so it's our place to kind of be able to fund those ideas and see them come to fruition. When folks ask about why is it that we focus on 3 sectors that we do, and why don't we focus on things like financial inclusion, why don't we focus on medical devices, or even why don't we just focus on a single sector like education, like healthcare? Our answer is twofold. One is we can diversify the portfolio by having a variety of sectors that we invest in. The second is this, that these problems are, the whole is greater than the sum of its parts. And so when we think about solving education or solving environmental crises, they're interconnected in ways that that a lot of people may not see on the surface, but and this is specific, a US specific example, but the Flint, Michigan crisis for those who aren't familiar, there was a crisis in Flint that there was lead in the water for dozens of years. This was something that was hidden by the government. And it sadly speaks very well to our thesis that there were environmental impacts of that, of there being no clean water. There were health impacts of that, of young children in particular getting cancer, getting kind of diseases that were not treatable, and educational impacts of students not performing as well because they didn't have access to clean water or clean air. And so when we talk about kind of what the consequences are to not investing in solutions there, we think about it as, this is multifold. I've gone pretty deep into what CityLight does specifically. What our kind of focus areas are highlighted on this slide, but I want to spend probably 5 minutes on this slide just to paint the picture of how we think about the impact investing landscape. And I find this slide very helpful for just understanding what is impact investing, what are the different types of impact investing, and I'll stick to venture capital specifically for the purposes of this conversation. But broadly speaking, impact investing cuts across literally everything. You can find it in almost any asset class, in any sector, and it's a very subjective definition of what does impact investing constitute. I will have my own definition. That doesn't mean that anybody else's is wrong or incorrect. That said, I will have kind of my own perspective, and others should create their own perspective around what does impact investing actually mean and how do I define what impact is. But for the purposes of kind of walking through this slide, the way that CityLight thinks about it and the way that I think about it is any impact investment or impact investing fund is going to have one or more kind of selections out of each of these 5 buckets. So sector is fairly straightforward. There you will find funds that are totally generalist. They're investing in all of these sectors. You will find funds that are specific to a particular sector and only look at education or only look at climate change. CityLight is a little bit unique in having just a subsection of these selections. But we, as described in the previous slide, we kind of have an explanation for why is it that we focus on these and not on others. The reason that we don't focus on medical devices, housing, financial inclusion, and other sectors is none of us feel smart enough to make decisions there. There are other funds that focus exclusively on housing or exclusively on financial inclusion, and we just don't have the edge to kind of make decisions when it comes to companies that are in those sectors. So again, for CityLight, we're focused on the top 3 here. Geography is another pretty common kind of distinguisher for impact investors. You have company or funds that look completely international, funds that only focus on emerging markets, funds that focus on regions. So that might be, that could be the Northeast of the United States, or it could be Southeast Asia, kind of different definitions of what regions are. CityLight only invests in the domestic United States, mostly for legal reasons. We, our lawyers only really know US law. And so we're somewhat limited to that. Local US tends to be impact investors that are specifically focused on a particular city or region where their aim is to create socioeconomic development in that particular area. And I'll get to that in a second when I go to impact strategy. Asset class is also fairly straightforward. So cash is usually just donations. Public equity is, you see a lot more of impact index funds or mutual funds or anything that kind of allows you to filter the different public equities by what you would like to keep out or what you would like to screen in. I'll get to that in a second with impact strategy. Fixed income, social impact bonds have become more popular. I'm not going to spend the time to go through exactly what that means because they're fairly complicated, but if you want to look up what a social impact bond is, there's pretty reasonable explanations online. Real assets tend to be real estate, low-income housing, things like that. Private equity and venture capital can probably be grouped into the same category here around, making a relatively small investment, anticipating a very high return, but investing in companies that are smaller or relatively early on in their life cycle. And I would say from the Global Impact Investing Network has a good breakdown of where impact investing dollars fall in terms of their asset class. And so actually a very, very small percentage fall into the venture capital bucket here. A very large percentage of companies that would identify their funds as going to impact investing are in the public equity space, or we see a lot in kind of infrastructure, which I would group under that, depending on what the company is, probably private equity or real assets. I'll skip over impact strategy for just a second, because that is one that is probably the more defining differentiator between different types of impact investing. And so on the return profile piece, this is where impact investors, and I'll speak for myself specifically, but this is where we always get the question of, well, if you're an impact investor, how do you trade off financial returns and impact? For CityLight, the answer is we don't. We don't believe that there needs to be a reduction in the amount of impact that we have in order to have a greater financial return and vice versa. We are looking for companies where the product or the service itself is exponentially scalable. And it has solved the problem early on in its life of how do I have impact as a company? And if I can answer that question and I can demonstrate that I have impact that early on, then the answer is I just need to scale that as much as possible and reach as many people as possible. And I can multiply the impact that I have by magnitudes. And so we target market rate returns, meaning we're targeting the same returns as traditional VCs that don't have an impact mandate. There are many impact investors, whether in venture capital or otherwise, that do not target market rate returns. And there's two kind of classes of investors that I would put underneath the market rate returns, and those are the below market and off market. You can group those together to some degree, but I would think about it as investors that are willing to take a lower return in exchange for a higher rate of impact. And so that might be investing in an emerging market where you know that the return is going to be lower just based on the financial reality of that country, but you're willing to do that because you want to put more money to work in that specific region. Or it might be investing in a company where the total market is significantly less than a more traditional venture. And you're willing to do that because you want to see change within that specific market or that specific demographic. And so you very intentionally are saying, I believe that having this lower return will allow me to have a greater impact for this specific population that I'm focused on, or the specific region that I'm focused on. The way that I tend to think about that is it all comes down to scale. So for CityLight, we target market rate returns because the types of products and solutions that we're investing in are applicable to hundreds of millions of people. And what that means is for if the companies that we invest in are successful, their target market, what they can achieve in terms of revenue, is significantly higher than if we were limiting it or filtering it by a specific population filter or a specific region, where you kind of top out at a certain market size or a certain penetration rate. And so that is what some impact investors are looking for, because they want to see very clear results in a particular area. But we target anything that's applicable across the US. Anybody can use it, and that means that it's super scalable. And then the no return profile is basically just traditional philanthropy. So investors that are looking to put money to work but aren't expecting a return whatsoever. That leads into a little bit of the impact strategy. So I'll talk a little bit more about what product-based impact investing means, and that is specific to what CityLight does. But just to walk through a couple of these other impact strategies so that you guys are familiar, screens really has to do with filtering in and out. And so you see this a lot in more public equities than you do necessarily in private investing, where mutual funds or investment banks or wealth advisors will say, we are going to filter in any company that has more than 50% women on its board, or filter out any company that focuses on guns and ammunition. This has become probably the most popular impact strategy to date and is tied very closely to ESG. I'll get into what ESG means in just a second, but you see a lot of public portfolios and a lot of large money managers focusing on ESG as kind of the definition of their impact strategy, and using one component or multiple components of that to say, what do we filter in, what do we filter out? But I would think of screens in that way. ESG I'll get into in just a minute, so I'm going to skip over that for now, as I will for product, because I'll go into that in a lot more detail. People-based impact investing, when we think about what is the definition of a person-based impact investment, That is typically either focused on who is the founder of the business or who is the primary customer of the product or service. And so when we talk about people-based investing, that typically is closely tied to DEI, and thinking about investing in underrepresented founders or companies that serve underrepresented populations. The thesis being that if I can invest in more people who look like this or invest in solutions for people who look like this, I can create a more level playing field. The same is true for place. A lot of investors in the U.S. will identify as place-based investors. The aim of a place-based investor tends to be job creation. So they're focused on a particular city or region where their aim is to provide socioeconomic development to that area. And then behavior is around not necessarily what is the end product or who creates that product or where is it based, but what is the supply chain that they use? Is this an ethical, are they using ethical labor? Are they, do they provide health insurance to their employees, or are they paying their employees above a minimum wage? And so what CityLight likes to say is we are not kind of screening out for any of these other impact strategies, but our primary filter is product. If we can find a company where the product or service generates positive social or environmental impact, and it is founded by a person of color or a woman, and it is based in a region where there typically hasn't been startup capital flowing, we will do that deal all day long. But our primary filter is, does the company itself provide positive social or environmental impact? Primarily because under our thesis, people, place, and behavior can be changed. And so if we're an investor at the seed stage in a particular founder, because our thesis is we should invest in underrepresented CEOs, if we get to the Series B stage and that CEO gets replaced, we don't want to run into the risk of, well, does this still qualify as an impact investment under our thesis of people? Because if we can replace where the company is based or who's running it, we don't want to find ourselves in that situation. And so it's much more difficult to change the product of what a company is creating versus who's running it or where it's based. So I've spent probably 10 minutes on that slide. I'm going to go to the next one, which is specific to product-based impact. So we think of product-based impact as basically the impact of a company working in lockstep with the revenue generation. And so, in other words, the company only works if the positive impact is generated. And I'm going to get into a specific example from a company in our portfolio just to make sure that this is abundantly clear. But I'm going to go into a little bit more about the kind of different types of impact measurement and management ahead of getting there. So I said that I would talk a little bit more about ESG. This is a term that is thrown around a lot, and that a lot of folks, I would say, are using interchangeably with impact investing. And that's not wrong, but it's not completely right either from our perspective. ESG encompasses a very broad range of impact. And generally, from my perspective, when a fund or when somebody is talking about, this is an ESG focused company or an ESG focused investor, they're typically talking about one of these sub bullet points. And so they're focused on gender and diversity policies, or they're focused on energy efficiency. It is uncommon to find a place that is doing all of these. And so, but the way to think about ESG, I would say, is you're focused on what are the environmental impacts that a company has, and then what are its internal policies and procedures. So governance is a big piece of this, particularly at the public equities level, partially because that's a relatively easy filter to put on every company, regardless of what it's creating. You can measure how many women are on its board, what's the diversity of its employee population, does this company provide, the same wages to its lowest wage employees as it does to its highest wage employees? And so I would caution folks to not conflate ESG with impact as just, two interchangeable terminologies. ESG tends to be much larger in terms of what it is talking about. And when you hear someone say, I work for an ESG fund, or I'm focused on ESG, I would ask kind of, well, where within that structure are you focused? And to be somewhat cynical, I think that there are a lot of funds that will claim to be ESG focused, and they would struggle to tell you exactly where on this map they fall and what exactly they're focused on. But skipping over that for now, one of the things that differentiates impact investors generally from more traditional VCs is the measurement and management of impact. And I would say most investors in the impact investing world are agreed to this general framework of the definitions of kind of what you measure and how you do that. This slide comes specifically from the Kellogg Foundation here in the States, who did quite a bit of work back in the early 2000s around identifying different types of impact and different types of metrics that they had been focused on, mostly on the nonprofit side. A lot of impact investing came out of lessons that people had learned over the course of working at nonprofits and creating theories of change and realizing nonprofits, again, this is a personal opinion, but nonprofits are somewhat limited in terms of the amount of capital that they can dedicate to any particular project. And so sometimes it takes the private market to step in and say, we have the capital to fund this from day one to $100 million in revenue, but we have the proof points from the original nonprofit work that we know this is going to work, and we know people are going to pick this up and it can become scalable. Going back to specifically, what do you measure? I would say what distinguishes impact investors for the most part are the light blue sections on the right-hand side. Most investors are going to count inputs and activities because you know exactly how much you've invested, how many people are on the team, what the company is doing. And so whether or not you're tracking this kind of in a spreadsheet, most funds are looking at, okay, what is the inputs that I'm associating with this investment? What distinguishes impact investors is not necessarily outputs, because for most startups, you're looking at key performance indicators or KPIs. And so you might say, I want to, this example gives number of people reached, items sold. You're usually tracking, number of users, dollars per user, different KPIs that are indicative of, is this product working in the way that it's intended? In terms of outcomes, impact investors tend to be very defined in terms of what outcome am I aiming for. So I have a particular way that I see the world around, investing in education means that people get better jobs. It means that they have higher salaries. It means that they are not turning over or not becoming unemployed on a more regular basis. I need to see metrics that clearly demonstrate that from the company in order to say, the outcomes that I'm looking for are being achieved. And from CityLight's perspective, companies should know that information because it's telling you whether or not your product works. I don't want to invest in a product where I'm kind of, crossing my fingers and hoping that the impact is there, hoping that people actually want to use the product. The example that we give frequently, which is admittedly a US specific example, is for-profit colleges. There are a lot of schools in the United States that were optimized for putting as many people into seats as possible. So they were optimizing for revenue. They wanted to collect as much tuition as possible. But then when people actually matriculated or enrolled, they had paid their tuition, and there was no focus on, does that person actually go through the process of taking the class, of earning a particular a grade, or of getting a job afterwards. And what ended up happening for those for-profit schools is because they were not focused on the outcome for their stakeholder. Now the United States government has essentially said anybody who took out a student loan to go to one of those schools is going to get that loan forgiven, because these felt more like Ponzi schemes than they did like an actual education. That got a little bit on my high horse, so I apologize. But what to take away from this, what you want to focus on as an impact investor is what are the outcomes, and that's very closely tied to kind of what is my investment thesis, how do I see the world developing, and then impact. So impact, as this slide indicates, is kind of measuring the additionality that you're giving to the world. So what would have happened if this company did not exist? Would these people have had access to this same service? Would they have had access as quickly? Would they have been in the same situation? And that becomes somewhat difficult to measure, but different impact investors do this differently. CityLight, as a rule, tends to rely on third-party research to say, here's kind of what the baseline was. And so we measure additionality based on that as our kind of benchmark comparison to what our companies are doing. I realize that I'm half an hour in, so I'm going to keep going through this and hopefully get through the whole presentation before we get to Q&A. If you look at impact investing, and you look at different ways to measure and manage impact, you will be greeted with what we call the alphabet soup of impact investing, which is basically all of these acronyms like the SDGs, IRIS, GEARS, SASB, GRI, B-Lab, IMP. It's very overwhelming. What I would say generally on this point is there are a couple of organizations and institutions that are generally agreed to in the impact investing community. I'll get to those in the next slides. But it really is very specific to each impact investor. The types of metrics that CityLight tracks, in a lot of cases, are the same as some of our co-investors who are impact investors. But in some cases, it's totally different. We're not optimizing for the number of jobs that are created by our portfolio companies. We have a handful of co-investors where that is the primary metric that they're looking for. And so my personal perspective is these methodologies, these resources try to be all encompassing around what are all of the metrics that you might look for on an impact investing basis to determine whether or not something is succeeding. And they do as good of a job as can be done, but it is very difficult to get everybody in the impact investing world on the same page about what are the most important metrics and why do we track them. So all of these are useful, but none is kind of the end all be all of impact measurement and management. The ones that I do think are highly influential in the impact investing world are the Impact Management Project. And I'll get to the others as we go through, but the Impact Management Project was a project that was started by Bridges Fund Management, which is actually headquartered in the UK. And it tried to the degree that it was possible, basically say, what are the commonalities between any type of impact investment and how do you evaluate those? I'm not going to go super deep into this. You guys will all get these slides later on, but it delved into defining impact investments as identifying what the company was doing, who is it impacting, what is the scale of that impact or how much, the contribution, which as we talked about was kind of the additionality that this investment is creating, and then the risk. And the risk, I would say, I tie mostly to the asset class. So is this something that is high risk, high reward, or is it something that, is a proven technology that you're just putting a little bit more money behind? This is the Impact Management Project, or the IMP, asks funds as they're going through the process of identifying kind of where their companies fall on this spectrum to basically say, what is my ideal investment? Do I care mostly about for example, only hitting the underserved. And I would be kind of okay with the contribution being less if I'm further to the right on this particular scale here. Again, I'll share this a little bit afterwards. There is a very long and useful explanation for what IMP is and how to use it on their website. The Sustainable Development Goals are probably the most widely accepted impact measurement protocol in the impact investing world. And partially that has to do with the fact that this has been a literally decades long project and something that is international in scope and fairly high level. And so it's a little bit easier to agree to something that is, high level. Of course, I agree with increasing good health and well-being. What's interesting about the Sustainable Development Goals that had not existed prior to their release at the international level was, and unfortunately, I don't have the video that goes along with this slide, but if you go to the Sustainable Development Goals website and you click into the specific goal, you will see targets and indicators. And the UN has become very data oriented around, I want to increase good health and well-being, or I want to increase affordable and clean energy. What are the metrics that I need to use in order to determine whether I am reaching that goal? And so we know where we are as a benchmark. By 2030, where do we need to be in order for these SDGs to be achieved? And that has become very widespread in terms of the impact investing landscape of funds now kind of mapping themselves to the SDGs and identifying, what are the metrics that we are focused on that that people will understand in this context. Iris Plus was, it's now being retired, but it was a very comprehensive library of different impact investing metrics that the Global Impact Investing Network had created. And City Light has used this in the past. A lot of different impact investors have used this. It was a good starting point for identifying kind of what are the different metrics that I could be looking at if I'm investing in educational companies. Not all of them will be applicable, but a good number of them will be. And the good thing about Iris Plus was it kind of gave you direction on, what format should this be collected in? How should you be asking for this reporting, on what cadence, which is something that a lot of impact investors, especially when they're first getting started out, are not completely clear on. The IFC operating principles for impact management, I'm going to go very quickly through this, but effectively this was an effort by the International Finance Corporation to say, how are we thinking about impact measurement and management at different stages of the investment process? So from when we are sourcing the deal, how do we identify that it's an impact deal? How do we kind of institutionalize that when we are making the investment? Are we asking for them to report on a regular basis? Are we putting kind of compliance measures in place to make sure that the company remains an impact company? And finally, is there impact when the company is acquired or when they go public? Which is a question that a lot of folks have around, once the investor is no longer a part of or a major owner of that company, how do I ensure that it is still having the intended impact and that it's not kind of taken in a totally different direction? So again, I'll share all of this afterwards, and all of these are, there's plenty written on each of these different frameworks, but I just wanted to paint the broad picture of kind of what's used on a regular basis. For City Light specifically, we require that companies report to us on impact metrics on an annual basis. Most of them do it more frequently than that, but it is a condition of our investment that they identify what those metrics are prior to us investing. And so I'll go into exactly what each of these things at the bottom is, but we sign a side letter with every single one of our companies that says they commit to track between 5 and 10 metrics that we've mutually identified to indicate whether or not the product is working. And the idea behind that is it's the same kind of the same kind of KPI or indicator as revenue or as an operational KPI. If we start to see that impact is dropping off, but so for example, if impact is dropping off, but revenue is continuing to grow, that's a red flag for us, because it means the product isn't working the way that we originally anticipated it would. Maybe we're tracking the wrong thing, or maybe this product isn't actually working and you're going to end up in a situation where you've oversold. And yes, revenue looks great, but your customers are going to end up being disappointed because the product doesn't do what it said it was supposed to do. And you're going to end up in a place that's even worse off, because a year from now, nobody's going to re-engage with you to repurchase your product because it didn't do what it said it was going to do. I'll go into what the impact pro forma is. We talked a little bit about industry benchmarks. City Light participates in virtually every survey or different kind of evaluation process for a lot of these different groups to align ourselves with their methodologies. We also candidly are some of the steering committee for what should that methodology be. City Light has been around for the last 17 years. And so we're one of the older impact funds out there, and we're frequently looked to as one of the funds that can be kind of the guiding light on what is best practice here. The impact beacon is something that we've developed internally. You guys can go look at it and play around with it. It's just impactbeacon.org. It is taking a lot of the process that we do internally around impact metrics and making that available to anybody. Very quickly going into a little bit of our process specifically. And I'm not going to spend time on this slide because I go into it pretty specifically. I'm going to give an example from our portfolio as to what product-based impact means and how we kind of do all of the tracking and management from the fund perspective. So one of our portfolio companies is called OhmConnect. It's what is called a residential demand response provider. And so what OhmConnect does is effectively integrate with Nest thermostats or smart plugs or electric vehicles, anything that can be plugged into the electricity grid and managed remotely. And OhmConnect contracts with electric utilities to basically say, listen, when and I don't know if this happens in Europe or the UK as frequently, but right now in California, there's a heat wave. And when there's a heat wave, it means everybody has their air conditioners on at max capacity. But what that can create is a situation where the electricity grid is being strained to the point of breaking because the grid simply can't handle the amount of demand that's being asked of it. And the only way that they can meet that additional demand is to turn on extra supply, which means typically turning on a coal-fired or gas-fired power plant, which has significantly greater carbon emissions than the cleaner power plants that we currently use. So what OhmConnect does is basically provide flexibility by saying, we're going to ask, 1,000 households to reduce their energy demand through their smart plug or thermostat or electric vehicle for 15 minutes a day. And that is going to provide the flexibility on the grid that the utility needs to not turn on that additional power plant. So walking quickly through this example, OhmConnect contracts with an ISO, I would just think of as a utility. And then on the user side, they sign up for the OhmConnect service. They connect their IoT device, whatever it is that they have, to OhmConnect. At the time that they call them an Ohm hour, at the time that the grid or the utility say to OhmConnect, listen, at this hour of tomorrow or next week, we predict that there's going to be too much demand for us. Can you ask your users to reduce their energy demand? OhmConnect will send a signal out to all of their users to say, reduce your energy usage for the next 15 minutes, and we will pay you to do that. So users will turn off their energy, they free up the space on the grid. And the most important thing from a product-based impact perspective is OhmConnect only gets paid if they do that. OhmConnect is not going to get paid if the users don't reduce their energy usage. And so there's a direct link between the impact that the company has by enabling the grid to not turn on those peaker plants, and how they get paid. The company is not successful unless they can demonstrate that impact, because that is their revenue model. And then they share those revenues with users. So users are incentivized to reduce their energy demand by saying, I can earn, $1,000 a year by reducing my energy demand during the hottest days. Where this falls into, or how we think about impact fitting into the full process is, we're evaluating a company on its impact the first day that we meet them. We're asking the founders, like, basically, what is important to you? Why are you starting this company? And if impact doesn't surface as a key component, it's probably not the right fit for us, because it means that person is not prioritizing impact as as kind of the end all be all of the company. And so we're using that as a screening mechanism to say, what are the things that we want to focus on? We also have, it's not a separate process, but during our due diligence process, we are focused on the impact. We dig deep into what are the data points that this company is already collecting. We're asking the customers, so in this case, the California ISO and the California Energy Commission, why are you working with this company? Is it because it has a greater amount of energy efficiency, or is this just good business? And if they don't talk about kind of the impact component of it, that's a red flag for us. The other thing that we do that is unique is we create what is called an impact pro forma. And so companies, whenever we are doing diligence on a Series A company in particular, we usually get a 5-year financial model. And one of the value adds of CityLight is we can look at that model and say, your drivers, or the things that are driving this model, the assumptions that you're making, are the same metrics that we would see on the impact side. So I've blurred this out here because this is private information to the company that we were just talking about, but the user growth is what defines what the financial outcomes are. So in this case, it's a very simple dollars per user times number of users equals the revenue. But by the same token, the number of users times the anticipated energy savings per user is going to give you the impact outcomes. And so when we think about what we want to track with the company, we're looking at the number of customers that we have, the dollars that they've saved, the avoided CO2 emissions. And this is what goes into our annual impact report, but it's also what goes into a side letter that we sign with the company that basically says, this is what you commit to share with us and what you commit to track over the course of the next 10 years that we're investing in the company. And we provide this report to our investors on an annual basis. The reason why we measure is a couple of different things. One is to keep the company accountable, to make sure that they are staying true to the what they said the company was going to be achieving. But we also think that it has multiple kind of ripple effects. So it helps with marketing and storytelling. We actually believe and think that our companies demonstrate that revenue is greater when a company, and stickier when a company has an impact mandate. It helps with hiring. You get very good talent when there is an explicit intent to have impact. If a person is deciding between, and this is especially true for millennials and Gen Z, if a person is deciding between a company that has a large amount of impact and one that doesn't, and the two offers are equivalent, you're probably going to go to the one that has a greater amount of impact. It helps with partnerships. Like Google is an exclusive partner of the company that I was just talking about, OwnConnect. And part of the reason they work with them is because OwnConnect can give Google credibility when it comes to energy efficiency. We have also found, and this was probably one of the more surprising things to me going into impact investing, and particularly into product-based impact investing, is you see the founding team start to think about this very differently, or you see them start to think about their companies very differently. We only ask them to track the metrics that are directly tied to their product. But all of a sudden you go to the board meeting and they say, you know what, it's really important to us that we hire more women and people of color, or it's more important to us that our product reaches like low income populations. And we're not forcing that, but you see that start having kind of secondary impacts. And on that, this is my last point. On that point, while CityLight is not we do not have a mandate to invest in diverse founders. We proactively look for those teams, and our portfolio is actually significantly more diverse than the average VC, partially because of what we focus on and the types of the populations that we invest in. But also we just believe that it's better business. Like there's an arbitrage almost of, if you invest in a more diverse team, you have a more guaranteed return. Like most of the research will tell you that. And so we proactively look for opportunities where, particularly if a company is serving an underserved or vulnerable population, usually the best person to run that company is somebody who's from that population. And so we proactively look for those types of opportunities. That is the extent of my presentation. I know that there are a couple of questions in the Q&A. So I will answer these two. Okay, I will answer these two to start with, and then if other folks have questions, feel free to put them in. Are there any additional tax benefits that are associated with having an impact fund versus a normal VC fund? So that varies region by region. We personally, we as CityLight don't have any tax advantages, but there are different ways to formulate your fund or to formulate your investments such that that might be possible. So, for example, in the U.S., there's and I don't know how widespread this information is, but there's something called opportunity zones, which are basically zones that have been identified, or zip codes that have been identified as by the US government as needing additional investment. And so there are some funds that have literally been created only to invest in opportunities that are based in those zip codes, with the explicit intent of, we get a tax break from investing in those areas. And so the structure of the fund is catered to that. Otherwise, it's, we don't require that our companies file or register as a benefit corporation. We don't require that there's any kind of taxable implications around it being an impact company versus not. And certainly from the US perspective, or sorry, from the fund perspective, we have not done anything differently than a traditional VC fund. We're the same structure. We don't have any kind of tax advantages. What happens if a company pivots and changes its product from an impact product to a pure profit product? So this is a great question. It is something that we luckily have never run into. Which is not to say that it would never happen. So I can only talk about this in kind of the hypothetical. The top line answer is, we stop giving them money. Like most of the investment that CityLight does comes after our initial investment. So we will write a $2 to $3 million check into companies at their Series A, with the intention of giving that company up to $15 million out of our fund. If they start to deviate from that kind of accountability of impact, we withhold the additional capital. And that may mean that the company can go out and raise money from different investors, and they can go on and be successful regardless. But for us, it no longer fits in our thesis if it starts to veer away from impact. The good news, and a way that we're able to kind of manage for that is, we typically sit on the board. And a lot of those decisions to go into kind of a pure profit direction have to be sanctioned by the board. And so we would vote against it and say, this is not what we invested in. This is not the direction that we wanted to take the company in. If it comes down to, that is the best direction for the company, we're not going to stand in their way. But generally, because of the types of products that we're investing in and the types of the types of impact that we're looking for, it doesn't, I mean, in my 5 years at City Light, it hasn't happened. And maybe I've just gotten incredibly lucky, but I think that's part of the reason that we focus on product-based impact, because that is a lot more difficult to change than some of the other kind of indicators of impact out there. Okay. Favorite investment that we've made so far: does having certain restrictions like ARR for Series A potentially limit capital intensive, truly groundbreaking social impact ventures? So let me answer the second part of that first. I think there are different types of impact investment for different types of businesses. One thing that I am very conscious of and that I advise founders on regularly is venture capital is not for everybody. Venture capital is given to fewer than 1% of businesses, and it is a very specific type of financing where you, as soon as you take VC money, you have tied yourself to performance and to growth that typical businesses don't do. Like, we're looking for companies that go from $1 million in revenue to $100 million in revenue in 5 years. And that's really hard. And it means that you are going to have to do a lot of experiments. You're going to have to try a bunch of different things and see what sticks. And hopefully you get it right, but 90% of our companies will get it wrong. That is not, I do not want every company out there to go looking for venture capital financing because they think it's easy to get, or they think impact investment is easy to get, or the quickest version. You can have a much more sustainable business by just slowly funding it or bootstrapping it, or by getting, traditional bank loans. VC is not always the answer. And I think that is particularly true for some social impact ventures where it may not be a highly scalable solution. You may be working on something that still needs to be tested and tried. And the more appropriate capital for that is, a grant or a loan from a bank at a low interest rate. And so it does, I would say it limits us. We still have plenty of deal flow. There are plenty of companies that we look at and would like to invest in. But from when it comes to kind of the truly groundbreaking social impact ventures, again, this is more opinion than don't take this as fact, but I think that it's more nonprofits and philanthropists that are funding the really groundbreaking ventures, because they get to fund things when they're at their earliest stages and see whether or not they work. And then what traditional or more like VC oriented impact is able to do is say, we saw an example of this. We know that this works on the small scale. What we're going to do is invest in something that brings this to the masses. And so it's our opportunity comes kind of, at one iteration later than the kind of philanthropic capital. In terms of a favorite investment I've made so far, that is an impossible question to answer. Because I love all of my children equally. But I think that high level, the things that I feel most strongly about are the companies that we've invested in that are focused on mental health and behavioral health, and particularly those that are focused on, in the US, the Medicaid and Medicare population. So those that are that have public insurance. Would I say it's harder to find a role at an impact fund? Do I need a differentiated skill set? So I would have had a different answer to this 5 years ago when I was looking versus now. I think that there are a lot more impact funds out there. What is hard about it is finding a role or finding the fund where you feel aligned to the type of impact that company is or that fund is focused on. It took me, I worked for a variety of different impact funds before I ultimately landed at City Light. And I think I was very lucky to find a place where the impact thesis that City Light has is very much aligned with my own. Prior to City Light, I was working at a couple of funds that were focused on emerging markets, with the thesis that, investing in emerging markets was creating socioeconomic development there. And so but the actual companies that we were investing in were not, by my definition, impact companies, and I felt like I was missing that from being in that world. So it's not harder. You don't necessarily need a differentiated skill set. Like the top skill set that people are still going to ask for, and that I was asked for 100 times over, was finance. Because the impact piece is very objective to each individual fund that you work at. So some and funds will want to teach you what their impact thesis is and how they think about it. You definitely should have kind of a demonstrated commitment to that. I would not have gotten the job that I did if I had not shown kind of a heavy commitment to the impact side of things, but I had to have the other pieces checked off before I was even going to be considered. One small side note there, I was asked 100 times, like I said, what is my whether I was an operations person or a finance person to get a role in VC. I didn't have either of those backgrounds. And I ended up taking an internship at a startup to be able to say that I had an operations background, even though I still wouldn't consider myself an operations person. Do not take no for an answer, essentially, when somebody tells you, you have to do, the number of people who told me, like, you have to go do investment banking, or you have to go do consulting, or whatever it is, before you're going to get a job in impact investing. I am evidence that that is not the case. So if that is what you are working towards, continue to work towards it. Okay. Does the focus on impact investing give us access to LPs that other funds don't have? So CityLight, our LPs are, and I apologize, I know I'm going over, but hopefully some folks can stay on. The way that we talk about our limited partner base is every investor that is invested with CityLight has invested out of their impact focus. Nobody is investing in CityLight based on we're out of their VC allocation. It does give us access to more family offices and foundations than maybe a traditional venture capital fund would have, but again, out of the capital that they've allocated to impact investing, because for those organizations in particular, they usually have a mandate that the investments that we make out of this endowment have to be mission aligned. Which is both a blessing and a curse, since CityLight is a multi-sector fund. Sometimes we can't get investment from a family office that's focused on education, because they'd say we can't invest in anything that's not education, and we can't promise them that we'll invest in only education companies. So we do get access to some different LPs, but it's usually the same LPs, just a different pool of capital. Okay. Examples of impact unicorns, companies that have really achieved scale that non-impact VC funded companies have. So I can give some examples of companies that I think are impact unicorns. But again, it's really going to depend on what your interpretation of impact is. So a lot of people will point to Tesla as an impact unicorn. Like, they are creating electric vehicles, they are reducing carbon emissions. There are a lot of things wrong with Tesla. And so, but equally so, I don't think that there's any individual company from a traditional VC fund that I would point to and say, nothing's wrong with that. They have no adverse impact on the world. And so I would say Tesla is one of them. SoFi might be another one. Etsy is one that a lot of people point to as empowering women and people of color to create their own businesses. Livongo is another one, trying to solve diabetes. There's a laundry list of companies that we would point to as these are massive impact companies. But again, it really depends on how you think about impact. If you want impact, and this is something that I had to kind of come to terms with, if you want impact to be only focused on the lowest income populations and only things that are focused on education or financial inclusion, et cetera, you probably will be disappointed. It is difficult to get a company that focuses on people who don't have money to spend in regions where they can't be reached, and for services that traditionally haven't reached them. It's just really, really hard. That doesn't mean that that solution doesn't exist, but part of the reason that I like what City Light does is we've taken a couple of those filters off and said, if we can create a solution that works for the majority, then hopefully we can eventually get that to go to the people who really need it and who might not otherwise have access. Say you felt the company had even better or worse projections in what happens in that scenario. I'm not 100% sure I understand the question for if we get the 5-year projections, if they had better or worse projections. We will almost never say to a company like, your projections are worse than they should be, because the company should be putting their best foot forward. We're not going to be the ones to say like, actually, we think you can do better, because no matter what, whether you're an impact VC or otherwise, if a company sends you a projection, you're almost automatically going to cut it in half and say, okay, in reality, this company probably grows half of what they anticipate. And so what does the company look like at that point? And so we are never going to encourage a company to say things should look better. We will also not encourage them to say, hey, things are actually a lot worse than you anticipate. But internally, we're going to be discounting whatever projections they send us. I don't know if that answered your question, so feel free to send more clarity if that's helpful. But the last one, many thanks for sharing. Compared to traditional VCs, what are the typical fund return target and investment timescale? So I can speak for City Light. We have the exact same structure and the exact same timescale and target return as a traditional VC fund. So I would say our target net IRR is in the 15 to 20% range. We would obviously like to outperform that, but we're trying to give investors 3x or 4x their money back at a minimum. The time scale, we generally would say, we're on a 5 to 7 year timeline for harvesting the companies in our portfolio. That could be, we've had companies that have been anywhere from 2 years to 12 years. But that's pretty typical for any VC fund. There are some impact funds that identify as more patient capital. And so they have a longer timeline or a longer investment period or a longer holding period, where they say, so for City Light, we invest over 4 years. We can hold any individual company for up to 12 years, at which point we need to harvest. Or we need for there to be an acquisition or an IPO, or we need to get bought out of that position so that we can return money to our investors. There are some VC funds though that say we're going to do that over 15 years, not 10 or 12. But we're pretty standard for a VC fund. I know I've gone about 10 minutes over. I think I have answered all the questions that were in the Q&A. But I will put my email in the chat here. If people have questions, if people want to get in touch, that's my contact. I'm also Sarah@futurevc.com. So if you missed the City Light address, you can reach me that way. But hopefully that was helpful and I didn't talk too much.
That was amazing. Thank you so much, Sarah. That was brilliant. So insightful. And we'll be sharing, I think we'll be sharing slides afterwards with the group.
Yeah, I will send them over to you.
Okay, amazing. Thank you so much. Thanks everyone to joining today. All should be proud of yourself for your first week. And we'll be back on Tuesday with your next masterclass session.
Bye, everybody.